Good afternoon, expats. My name's Jeremy Harper, and welcome to another episode of Expat Mortgage Podcast. We've got a special guest in the hot seat. We've got Richard Young, CEO from Midkey. Good afternoon, Richard.
G'day, Jeremy. How are you? Glad to be joining you today.
Thank you very much for your time. Yeah, so look, excited to put you in the hot seat. We've got an exciting new product from Midkey. Well, firstly, we'll introduce, what you guys do, but this is another solution, another tool in our toolkit that we can provide our expat listeners on the mortgage front. So it's a little bit different from a traditional mortgage. So we'll jump into it. But I guess, first of all, do you want to give the listeners a bit of an intro on who you are and who Midkey is?
Yeah, I suppose I was once an expat for quite a period of time, living in Hong Kong and Shanghai. So I've lived the dream, as they say. I came back in 2020 around COVID, and after a few months off, having left Macquarie, I started with one other business partner, Midkey, and we established the business to solve a very big problem that we're going to talk about today.
Yep, fantastic. And so what would you classify Midkey as? Would we say they're a solution-based lender?
Definitely. So if you like, we are a home equity release loan with no monthly payments. So that's in a nutshell. So what does that mean? Or we have simple interest in our loans. We have no loan term. We can lend as a first or a second mortgage, but the borrower's got to have at least 20% equity in there. So we're really for that segment of the market, Jeremy, that is sort of, we call it home equity rich, but maybe cash flow constrained. And there's a
Yep.
number of reasons that we'll get in today, potentially why that's seen under loan serviceability as cash flow constrained. So
Ye-
who are the borrowers? The borrowers could be, middle-aged or older couples who've got significant assets, maybe have a first mortgage they're servicing, wanting additional capital for renovations. They could be business owners who want to inject more money into their business. They could be people who've agreed a financial settlement after a divorce and want to keep the family home, or one party does. There's a range of different users, including, we'll say, some successful Australian expats who own a lot of property in Australia and want to tap into that property for additional wealth creation strategies.
Yeah, that's a good point. So where we're at the market in terms of serviceability, obviously with rates increasing, serviceability is tight, particularly for expats with the way the banks will assess your income. They'll shade that back. So it does make servicing difficult, or accessing some of that equity that some of our expat clients have. And for some of them, they've built up substantial equity. So I wanted to kind of highlight the fact you talked about that, the ability to go as a second mortgage. And I think that's really important. If someone's got, let's say in Sydney, a property worth a couple of million, they've got maybe, $500,000 or $1 million as a first registered mortgage. There is a cost benefit analysis of comparing to say, okay, well, if we want to access that equity and we have to take, let's say you're with an ANZ or a Macquarie of the world, initial mortgage, does it make sense to refinance the full amount to a second tier lender to access equity versus using someone like a Midkey, where perhaps you're only accessing a small portion of that equity available, and that can actually work out to be a bit more cost effective using a Midkey?
Oh yeah, definitely. I mean, so I think it comes down to a choice of the borrowers. Sometimes, if they have the ability to cash flow, obviously the major lenders, great, they provide a great service. But we're really looking at as you mentioned at the start, being a solution-based lender where people have got all that equity in there. They want to use that or make the decision that no, I don't want to refinance out the whole mortgage to if you like, a low doc or a more expensive overall funder. I'm going to take a slice with a Midkey, and that's going to provide, if you like, the gap capital for my wealth creation strategy. And we see that in a lot of instances where, you've got very good borrowers who are servicing their first mortgages, doing a good job, and they're just looking for that additional capital. We also have borrowers that might want to reduce some of their first mortgages as well, Jeremy.
Yep. Okay. So let's get into, I guess, how it works. So let's say, as an example, we've got someone that's coming to us. They want the Midkey. They're after, say, 500,000. I
hmm
guess, what are some of the things that we need to discuss and go through in terms of the terms?
Yeah. So the good news is, I suppose, we hand over the money, the $500,000, and then interest accumulates over the period of the loan, and it's simple interest. It doesn't compound. So the important thing is there's no fixed loan term on Midkey loans. So the borrower is put back in charge effectively here, and they decide when they repay us. So when they repay us, so there's no payments during the no principal, no interest payments from the time we lend the money to the time they decide to repay us, whether that be based on a property sale, a refinancing, or even expats returning and restoring their serviceability under the Australian market, and so a range of different ways that people can refinance us out. But the other piece of the Midkey loan, which is, I suppose, unique to us, which we call our exchange of value, is in exchange for providing the capital, no monthly payments, we charge a deferral fee. So
Yep.
what's a deferral fee? A deferral fee is simply if you've got $1 million property and we lent $100,000, that would be a 10% LVR, and we would participate in 10% of the upside of the property. So what I think the thing about it is, in designing Midkey, we wanted to be aligned with the borrowers. So we're sharing a little bit of the slice of the upside in the property, if that happens, with the borrower, in exchange for the flexibility throughout the period of the loan, which they decide, what that is.
Yep. And so you talked about simple interest and compounding. So this arrangement would be simple interest. Do you want to perhaps just give us an idea of the differences between the two?
Yeah, sure. So simple interest, if it's a 7% on $100,000 for 10 years, it's $70,000 simple interest.
Yep.
Where you are compounding, say at 7%, you're not only paying interest on the $100,000 in year two, you're paying the interest on $107,000. So there's no interest on interest. So you're not compounding. It's simple interest based on the loan value at the start of the loan. So no
And
interest on interest.
if we decided to, on say year three of that $100,000 loan, if we decide to pay down half of it in year
Yeah,
three, does
yeah.
that simple interest calculation update?
Yes, so exactly. So I mean, when any partial repayments on a mid-key loan will be across the principal of the repayment, a portion of the simple interest, and any mark-to-market based on an independent valuation of any deferral fee that's payable.
Yeah, I think that's really important. If we look at some of those products in the market where they're doing a reverse mortgage, quite often you'll find the interest is compounding. So it just erodes a person's equity position when they do exit.
Yeah, I suppose versus a traditional reverse mortgage on the interest component of our loans, we sort of sit today at around 7.6%. Traditional reverse mortgages, which are compounding, are at a higher interest rate, 9.25%, 9.5%, broadly speaking. So they're compounding and interest on interest at a higher rate versus a mid-key, which is the flat simple interest throughout the period of the loan.
Yep. Okay, good difference. So I guess looking at what are we looking for in these type of deals, because obviously this is not going to be suitable for everyone. So, as you mentioned before, if it's a high LVR, if it's perhaps in a location that's not desirable, but I think we've got the three Ps. So we'll go through them. So we've got property, position and plan. So property is, where do you guys like the actual property to be located? Are we talking blue chips, spots, postcodes, or?
Yeah, we do have a postcode, if you like, scenario manager in our broker hub. Look, we're in all the major cities, bar Melbourne. We won't jump into that today, but in their major, we'll call it regionals like the Wollongongs, the Newcastles of the world, or the Gold Coasters, etc. So, yeah, we're in those major parts. So we don't do rural. We don't do sort of, if you like. Well, sort of only residential properties, of course. We're not doing commercial
Not
properties
doing
here.
commercial. Yep.
Yeah, and we're not doing say regional towns, etc. So yes, postcode driven, and we are, yeah, we do all suburbs within our, including sort of wider suburbs, Jeremy. So there's no sort of, if you like, snobbery around the postcodes on this, as long as we've tried to be as broad as possible.
Okay. And in terms of position, so we've talked a little bit about LVR. So, what sort of equity position should the clients be in prior to looking in a Midkey?
Yeah. Well, as I think we mentioned at the start, you've got to have at least 20% equity in your property for us to have that conversation. Most of our loans, or 80% of our loans actually are second mortgages, but the average on the portfolio in terms of combined LVR is around sort of 47, 48%. So actually combined is quite low. As an LVR on a first mortgage will go up to 35%. But in combined with a first mortgage, which has to be principal and interest reducing, will
Yep.
go up to 30, where the combined does not exceed 80%. Now, you might have someone who's at 80% and saying, I can't afford it for cost of living and interest rates have gone up. We can pay down some of that first mortgage, re-amortize it, etc. So yeah, we in the capital stack, we can be a first mortgage or a second. Those LVR limits apply, but we really do have to sit and where the borrower does have most of ours have significant equity, but we tap out at 80% or, we've got a minimum of 20% equity.
Yep. Okay. No, definitely makes sense. And then the third P would be plan. So I guess this is like any of these type of products, it's that exit strategy. So what would you be looking for in terms of exit strategy?
Yeah, I mean, it's clear we have a conversation with borrowers at the time of lending the money, which is, what do you need the money for? How long do you anticipate to have it? Even though our loans have no term on them, we like to understand is this loan, not unsuitable for the borrower? And then we just clear plan, whether that be we're bridging to an inheritance, bridging to a business success, bridging to a returning expat returning and re-establishing the Australian market, some serviceability and then refinancing us out. Or a lot of people just, bridging to a downsizing event. So we're just very clear, and borrowers, we have that conversation of we need to understand for the objectives of the purpose of the loan, what is the purpose, and then they have to have a clear exit strategy
Yep.
around that.
Yeah. Okay. So we've got three scenarios to talk through, deals that we've had on our desk. So perhaps we'll just go through them just so the listeners can get a bit of an idea around, practically speaking, where Midkey would fit. So, our first one here, so it's Sue and John. They've got the $4 million family home in Sydney. They've had that for 28 years. So they've had it for some time. And then essentially they're looking at, their loan. It's essentially paid off. They've got about 250,000 outstanding. And they're looking to downsize. And this is a classic example where they don't have the capital to really do significant refresh works on the property. Costs of construction is expensive. So let's say, it's going to cost about 250,000 to paint, redo the kitchen, the bathroom, garden, and then get that ready for sale. And I think this is really important, this type of transaction right now, is not only will that appreciate the value of the property, they may be able to fetch another 400,000 or 500,000 because that's appealing, but it's that appeal to the market. So there's two things are happening right now in Sydney. One is construction costs are incredibly high. So it's not appealing for buyers to go to market and then buy something and then do it up themselves, particularly a family. And secondly, with the volumes dropping in terms of transactions, the buyers in the market that are out there, they are looking for that A grade type property. So the B type property is not moving. So in this scenario for Sue and John, the idea is really add some value on the sale, but add sale appeal. So with that in mind, so what do we do? How do we get the 250 out with Midkey?
Yeah, we do see, as you quite rightly say, this is a very common scenario where you've got people that have lived in a property for a long period of time. It's got great bones. It needs a bit of love to get dressed for sale, as they say. But a lot of these people, their incomes aren't what they once were. They become a little bit more risk averse. They don't want to add to their monthly outgoings. Or they can't, their incomes aren't sufficient to get money from traditional lenders for that purpose. So in a number of instances, we've seen this exact scenario where people borrow from Midkey, they do up their properties, and then they're not in if you like, a rush or a forced rush to when they repay us. If the market's not good, they can solve it because of the no low term. But yes, as you say, the money invested to achieve a better outcome, a multiple of whatever the Midkey loan was for, or frankly, as you say, the ability just to close the deal at
Yeah,
some increase in value. So those and doing that in an environment where the borrower is not, particularly older borrowers, who are not stressed around making monthly payments, given their
yep,
cash flows, very important.
correct. Yep. No, and that's really important. I think that even if they could get it from a traditional bank, a P&I, the bank would probably say we want this repaid over P&I, and if they're an older borrower, 28 years in the home, they may not get a 30-year mortgage. So even if it's 250, the repayments could be quite high. So that would put them under stress, and then they have to sell that property maybe in a time they're not comfortable and they're not getting the result they want. Great. So great outcome there. So we've got another scenario. This is for some Australian expats. They've got a property in Sydney. It's an investment property. So they're over in Dubai earning dirhams, and they've got a property in Coogee. So it's done quite well. It's worth 3.8 million market value. They've got about 900,000 on the property outstanding as a first mortgage. So they've got substantial equity, and essentially they want to use the equity to go again and grow their wealth, get the deposit and some costs. So they're looking for about $450,000. Now, because of their foreign income, the way the banks were assessing it, they were basically saying the tier one lenders were saying, we can't help you. Sorry, you've got too much outgoings overseas in Dubai. We can't afford that additional borrowings. We had two options, which we talked about earlier. One was perhaps do we refinance that 900 that we've got with the tier one bank, take them to a second tier lender, so that full 900 we're paying more for, or with a Midkey, do we keep the 900 in place with the existing lender, that doesn't change, and then we come in with the 450 with the Midkey. So what was our solution here?
Yeah, we see this quite a bit. And actually, I had a situation in 2017 where I came across this income shading at my lovely old place of work. Yeah, in this instance, we do look at how much equity the borrower has in their property. We look at sort of where they're expats working for, you know, legitimate companies, and they've got a track record of they're Australian citizens and they're retiring or repaying that first mortgage debt. We're comfortable once we've seen if they can service that first mortgage, or if they want a bit of relief on that, we could pay that down as well. But yeah, so understanding that our Midkey would be used as the equity chunk to buy another investment property and go on their way of increasing their wealth creation strategy through property, assuming, and you can see that most instances that, the rents on these places are going to cover, depending on the LVRs, any additional debt on that, property against a traditional lender as well. So we can provide that equity chunk, and given the borrower, the expat, for that, at least that piece, they've got a bit of cash flow relief in terms of the Midkey loan, but they can actually, more importantly, they can just get on with their execution of their wealth creation strategy.
Correct. And then the plan is once they come back to Australia, they'll resume residency, they'll take on Australian jobs, serviceability will change, and they'll have multiple options. They've got properties and Australian income, so they can either refinance, or if they want to sell down some assets to exit some of the debt, they can also do that at that point when they're Australian tax residents. So again, gives them that flexibility around using the leverage instead of sort of being tied to a tax outcome by having to sell overseas.
Yeah, I mean, it's quite interesting because Midkey, the average age of our borrowers is about 53. And so, and some people just use as a bridge to an ultimate sale event, or, can have it for a long period of time. But it's actually, and you use the example of the expat returning, absolutely, within they have the income at a certain level and they refinance us. 33% of our loans to date have been refinanced out. And,
Yep.
From various, if you like, life circumstances. But definitely that is one which we anticipate and welcome.
Yep. And finally, we've got this scenario where we worked on, so some older borrowers, and this is really interesting because I'm seeing this this is just around the dinner table happening all across the country, where they've got a lot of value in their family property. The parents are in their early 60s. They've got the house in Parramatta. It's worth 2.8 million. They've got a first on it for 1.1, and then they want to help their kids buy their first property. So they want to actually gift them about $250,000. Let's call that an early inheritance by using a Midkey. So in this scenario, because of the income, serviceability is tricky. They've got the 1.1 outstanding. So with increase in cost of living, increase in the interest rates, those parents in the early 60s are sort of could be struggling a little bit with the repayments. So we've actually got a larger Midkey in this time, so 650,000 to pay off some of that first mortgage. So bring that repayment down and then gift some of that money from the 250,000 each to the children to get them into that first property.
Yeah, this is a fantastic one because there increasingly is this tension, if you like, between the parents, as you mentioned, in the $2.8 million house, who quite like living in their suburb, in their neighbourhood, but they really want to help out their kids. And so the benefit of Midkey's no monthly payment loan in this instance is so they don't have to downsize. They can provide, call it an early inheritance or a portion of it. They can get their kids established with the deposits into the market. They can get some cash flow relief by paying a portion of the Midkey down off the first. So they reset themselves. So they're the winners. They're sitting there. They've helped their families out. They've remained in their home. They've improved their monthly cash flow. Their kids are happy because they can get on with life. So this is one that, is straight down the middle of the fairway for us, Jeremy, and we see that example many, many, many times. And, unfortunately, historically, some parents have said, look, I know we love living here and we know, but we need to downsize because I need to free up capital to help our kids into the market. So they end up moving, they move to a different suburb, which
Yeah.
their network's not there. So, I mean, this is a win-win for everyone.
Yeah, definitely. And I remember seeing or reading about statistically if people, particularly adults, if they've got their own property, so the children earlier, they have substantially better financial outcomes later down the track. If you get someone in the property, anchor them, bit of security, once they've got that deposit or some of that gift from mum and dad, they can be on their way. And obviously the balance of that loan can be assessed under the children's name only. And you're not having to do any guarantee loans where you're tying up the family home against the next generation properties. It's all secure. Of course, yes, that 250,000 debt is sitting under their property, but if, it allows the child to go and transact on a property under their own name only.
Yeah, and the sort of parents are sitting there going, okay, I can stay here and I in my home in Parramatta and I can continue to live here. Right? And it's sort of putting families back in control.
Yep.
And that's the thing. So these people worked hard, they built all this equity in their home, they want to help their kids. This is this classic home equity rich, cash flow constrained scenario, which is, as you say, is um, endemic's the wrong word, but it's prevalent or it's you know it's out there in a lot of instances in Australia, and that's part of the wonderful thing what we get to do at Midkey is help these people who've been good borrowers all their lives.
Yeah, fantastic. No, I agree. So just to wrap things up, so I'll just kind of wrap up how it works with Midkey. So, if you're a client listening, you're thinking this may be something that fits yourself or something maybe for your parents. What's the next step, do you think?
Well, you should talk to Jeremy. That's what you should do in first instance. No, I think you've got to, look at your objectives. I mean, a simple scenario on one page to your broker or your accountant or your wealth manager, just setting out the value of the existing property. If you've got a first mortgage, what is that? What's the use of proceeds for, et cetera? And what's your estimated time you want the money for, and what's your planned exit event or repayment strategy. And if you just send that through to your broker, to Jeremy and Atlas, and then he'll work that through with us through the broker hub at Midkey, and come back to you very quickly in terms of it's a pretty simple process. If you've got the equity and you've got an exit strategy, working with brokers such as Jeremy, the process is pretty seamless to
Yep.
get things done.
Yeah, definitely. So equity rich, cash flow constrained, or perhaps the borrower is struggling to show serviceability because some of those scenarios we went through earlier. So
Yep.
tick, tick, tick. Keeping people in their homes for longer, allowing them to sell when they want to. I think that's such a great takeaway. Helping if they've got some struggles with their business at the moment, which I know a lot of small businesses I speak to are, or looking to help their kids, or if they've just gone back to the bank originally, their existing bank, and they've just said no for whatever reason, could be a really good solution.
Yeah, I mean, the use cases, if you pop to the website, there are many that I think about it and framing it. Some of Midkeys are used for property related strategy. Some are just all about life. We're putting the borrower back in control of their money so they can make the decisions of, what they want to do with it, when they want to repay us, and what the use, how they want to use that money. So the use cases we've seen so far have been fantastic, across as you say, expansion, wealth creation, or debt consolidation, or bringing forward intergenerational wealth, or bank of mum and dad, the rent, renovate to sell, all of these, recovering after divorces. The list is very long. And the good thing is that, Jeremy, is this is this is your client's money and their wealth. So it's Midkey's a new, really interesting way that they can unlock that wealth for whatever purposes they might require it for.
Yeah, no, well said. Well, Richard, thank you very much for your time. I also hope all the listeners on today's episode of Expat Mortgages had some great takeaways. But we'll just, for the quick shout out to the listeners, please keep an eye on our socials. We have a webinar coming up later this month regarding updating the CGT on the tax and the lending front. So please subscribe to that. That will be well attended across the globe. We'll give everyone some post-budget updates on how that's going to impact expats. But until then, everyone, thank you, and we'll see you on the next episode.
See you. Thanks, Jeremy.
Bye-bye.